Today, all is calm, but is it the calm before the storm? Hello again, Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Just a couple of quick posts today. This is the last day I'm going to be making shows. And I wanted to start with a report in the AFR, who said that the Australian Prudential Regulation Authority has told banks to improve their reporting around crypto assets and to provide daily updates to the agency as it sought to gain more insight into exposures and vulnerabilities in the system following the collapse of Silicon Valley Bank and volatility of global lenders. While there's no suggestion Australian banks will or have suffered deposit flight, given they were capitalised and profitable, there are fears that increasing oversight and compliance activity relating to startups could freeze the sector and affect their ability to access banking services. Peter Cook, Chief Executive of ASX-listed payment services company Novati, said Australia's tight prudential regime was effective, but the current situation had put into question productivity gains driven by financial innovation. The growth of digital economy businesses is at risk if startups can't get banking services, and all of the growth and subsequent efficiencies of productivity and job growth that go alongside that. Mr. Cook said the increased supervision comes after startups pulled funds deposited with SVB, triggering its collapse, and after Credit Suisse suffered outflows from its customers concerned about its profitability as it attempted a complicated and lengthy restructuring process. Barrenjoey analyst Jonathan Mott told clients in the note that the situation remains stable for Australian banks, but warned confidence could be quickly eroded and bank margins would be pressurised. Our channel checks indicate deposits are not being withdrawn from small institutions in any size, and capital and liquidity buffers are strong, Mr. Mott said. But this is a crisis of confidence, and credit spreads and costs of capital will continue to rise. At a minimum, this will add to the margin pressures the banks are facing, while credit quality will continue to deteriorate. Already banks are understood to have become more cautious about where they allocate lending, given the pressures on their margins, which will intensify in line with global market turmoil. The fallout from the $17 billion worth of Credit Suisse's additional Tier 1 bonds being wiped out by the Swiss regulator will put even more pressure on local banks, given that they have to raise an extra $70 billion of total loss-absorbing capital by 2026. The major banks have privately stressed that the local crypto industry remains small and largely banked offshore because of existing concerns around anti-money laundering compliance. An APRA spokesman declined to comment and pointed to a recent statement which noted that the regulator had increased supervision of the banking sector. It's already difficult for startups to access banking services in Australia. It's hard to escape the suspicion that it's not about to get a whole lot tougher due to a banking crisis that has absolutely nothing to do with us, one startup founder said. No one is arguing banks should be forced to extend services to an extravagantly risky client, but they should be required to make transparent, explicable decisions on a case-by-case basis. If you apply an arbitrarily high risk weighting to an entire sector, where's the incentive for banks to offer their services? All you're going to achieve is the concentration of risk in an ever smaller pool of banking service providers to the startup community. APRA does not mandate banks' risk weightings, which are set by each bank individually, and it also does not publish any of the information it collects publicly and is using it solely to determine Australian banks' risk profile. One source said APRA was not the difficult point, and banks had been increasingly debanking startups recently against the advice of regulators, including AUSTRAC, the Australian Competition and Consumer Commission, and the Council for Financial Regulation. Another source said startups were also starting to worry about their apps offered through third parties, given the risk that funds stored in digital wallets could be frozen if bank services were suddenly withdrawn. The source pointed to those funds trapped in Unhedged, an algorithm-based investment platform that decided to shutter its investment services. Account holders have been unable to access their funds as they wait for auditors to wind up the company's consumer arm. As a young business, Unhedged is not yet profitable and raises capital to fund its operations. Due to funding constraints in the current market environment, we decided to pivot our company to a more capital-efficient business model, the company said in a statement. And on Tuesday, Unhedged founder Peter Baker said there was no risk apart from timing for customers waiting to access their funds. Crypto players said that the increased scrutiny could lead banks to deem the sector more risky, meaning they would cite heavier risk weightings as an excuse not to service the sector. These startup fears could make it harder to continue their banking relationships and operations like payroll. Now, last October, the Council of Financial Regulators, the ACCC and AUSTRAC, responded to complaints from the crypto and fintech sectors about being debanked because they sit outside of banks' risk appetites. Regulators said the banks should collect and share data about so-called debanking activities, make their processes transparent and fair, advise government of their risk tolerance, and consider investing to improve their capability to bank those sectors. Now, over in the US, Treasury Secretary Janet Yellen said on Tuesday that the US government could repeat the drastic actions it took recently to protect bank depositors if smaller lenders are threatened. Our intervention was necessary to protect the broader US banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion, Yellen said in remarks to an Bankers Association conference in Washington. The federal government is resolutely committed to mitigating financial stability risks where necessary, Yellen said in a question and answer session. The public should have confidence in our banking system. US authorities took extraordinary steps earlier this month to bolster that confidence following the collapse of Silicon Valley Bank and Signature Bank. Regulators guaranteed insured and uninsured deposits at the two institutions, and the Federal Reserve also launched a new backstop for lenders and altered rules at its emergency lending facility, the so-called discount window, to help them meet deposit withdrawals. Yellen said that the current troubles are notably different from the global financial crisis more than a decade ago, which was an issue with solvency. Today's challenge is contagious bank runs, and it's vital that lenders have access to adequate liquidity, she said. The Fed, which Yellen previously chaired, is the key institution, she indicated. The central bank's discount window and its new bank term funding program are working as intended, she said. We see the situation as having improved, with aggregate outflows from deposits having stabilized. Officials will continue to monitor the situation, she said. A coalition of mid-sized banks has pressed for an expansion of federal deposit insurance to cover all deposits, but Yellen didn't address that issue on Tuesday. And US officials have begun studying whether they can temporarily expand that coverage. Yellen also wouldn't speculate on what kind of regulatory changes might be needed in the wake of this month's bank collapse. We are currently focused on the situation in hand, she said in her prepared remarks, but we will need to re-examine our current regulatory and supervisory regimes and consider whether they're appropriate for the risks that banks face today. Yellen's comments come on the heels of 2 weeks of tumult in global markets and heightened worries over financial stability after the rapid-fire collapse of the US banks and a historic deal over the weekend that saw UBS Group AG agree to buy its troubled Swiss rival Credit Suisse. In the US, First Republic Bank continues to battle to restore confidence after a plunge in its share price. And JP Morgan Chase Chief Executive Officer Jamie Dimon has led plans to have a group of big banks convert some or all of the $30 billion they deposited last week with First Republic into a capital infusion. On Tuesday, Yellen defended the recent government measures as a swift and necessary response. The federal government delivered just that, decisive and forceful actions to strengthen public confidence in the US banking system and to protect the American economy, she said. The steps, she said, reduced the risk of further bank failures that would have imposed losses on the Deposit Insurance Fund. And she added that the US financial system was much stronger than in 2008, due in part to post-crisis reforms that enforced higher capital requirements for US lenders. And Yellen also said that the government hoped to preserve the role of small and mid-sized lenders within the larger financial system. Large banks play an important role in our economy, but so do small and mid-sized banks, she said. Treasury is committed to ensuring the ongoing health and competitiveness of our vibrant community and regional banking institutions. And separately, Yellen reiterated her call for Congress to increase or suspend the federal debt limit, calling that utterly essential. While President Joe Biden stands ready to engage with lawmakers on addressing fiscal sustainability, that ought to be done through the regular appropriations process, not under the threat of a catastrophic default, she said. And meantime, Wall Street's favourite volatility gauge tumbled as the rebound in stocks deepened, with a surge in banks and assurances from global authorities easing concerns that the recent financial turmoil could lead to a full-blown crisis. You can call it a calm, or you can call it calm before the storm, I guess. Whatever the case, the coordinated actions to resolve the banking turmoil has resulted in a semblance of order for now. The market's so-called fear gauge, or VIX, headed towards its biggest two-day plunge since May, and in the run-up to the Federal Reserve decision, traders are betting on another 25 basis point hike, with officials forging ahead with the battle against inflation and signalling commitment for financial stability. This is an easier market backdrop, said Nicholas Colas, co-founder of DataTrack Research. Expectations of a dramatic about-face for monetary policy are diminishing. Market expectations for near-term Fed rate decisions are now within the realm of possibility. That is good news. The S&P 500 topped 4,000, expanding its advance above its key 200-day moving average. And after briefly exceeding 30 last week for the first time since October, the volatility index plummeted to around 22. Every stock in a measure of US financial heavyweights climbed. First Republic Bank actually surged 30%, its best day ever amid optimism over a new plan under discussion to aid the regional lender. That said, shares in First Republic Bank dropped about 15% in extended trading after news that the troubled bank reportedly had hired advisors to review its options and to manage the crisis. And now the rally in the riskier corners of the market doesn't mean an all clear at this stage, though. To Matt Maley of Miller, Talbot & Co., investors should be careful about the conclusions they draw from the recent equity advance, as there are at least two ways to look at it. One is to think that the stock market is looking past this mini crisis and sees that the economy and thus earnings are going to grow quite nicely once we get past this problem, Maley said. But the other way to look at it is to think that the situation is still quite a dicey one, and the authorities are pumping so much short-term liquidity into the system that the stock market cannot decline over the near term. Several strategists are indeed growing concerned, with Morgan Stanley's Michael Wilson saying the risk of a credit crunch is increasing materially. The S&P 500 might find a floor at 3,800, but investors should sell into any rallies if the benchmark reaches 4,100 to 4,200, Bank of America's Michael Hunnert wrote. Bank of America's latest global survey of fund managers shows a systemic credit event has replaced stubborn inflation as the key risk to markets. The polling took place from March the 10th to the 16th, while money managers were witnessing the collapse of US lenders Silicon Valley Bank and Signature Bank and monitoring the turmoil in Credit Suisse before its historic takeover by UBS. The likelihood of a recession is also rising again for the first time since November, with a survey showing a net 42% of participants expecting a slowdown over the next 12 months. And another worrisome development is the extreme volatility in short-term government bonds that has now dragged into a ninth straight day. Treasury two-year notes in the US, which are normally considered a low-risk investment, saw a yield surge by as much as 21 basis points to 4.18% on Tuesday. And John Hancock Investment Management's Matthew Miskin is certain the Fed has run out of runway for a soft landing, and he's pointing to turbulence in the bond market to make that case. When the two-year Treasury yield starts acting like a meme stock, you've got some problems, Miskin said. The bond market is saying, yeah, you're going to raise rates, but it's going to be a mistake, and you're going to be cutting in the not-so-distant future. And so, as I turn off the studio for the last time, I want to highlight that the risks are very real out there at the moment, and anybody who thinks that we are past the worst of this mini crisis, I think is kidding themselves. Of course, the next couple of days we'll see the Fed decision, the Bank of England decision, and that will give us a bit of a clue as to where things are going next. But the level of uncertainty is very high. The cracks continue to spread, and as I discussed with Damien Klassen yesterday, of course, there are many other banks around the place potentially trapped into a liquidity squeeze and therefore a credit squeeze. So, over the next few weeks, mind your backs, watch the markets, and be prepared for the unexpected. And I'll be back down the track with some more updates from the other side of the world. I'm Martin North from Digital Finance Analytics, signing off from Australia. Cheerio, and thanks for all your support.